Karibu sana and welcome. So we'll go through our questions in partnership. Yesterday we had a discussion. We started the first question, we did not finish. So I'll go over the same question again, finish, then probably pick another two, and then we'll move on. The topic is taxation of business. So that's the first business we're looking at. We're looking at partnership. So from here, we might go to limited company. I might introduce a discussion on allowable expenses and disallowable. Then I introduce limited company, which could be the biggest business there is. After company, we don't have any other. So from partnership, we go to limited company. But before limited company, I'll have a discussion on section 15, what we call allowable expenses, and section 16 disallowable expenses. Then I can introduce limited companies, and that will conclude our discussion on taxation of businesses. So I'll read this question again. This question was April 2022, question 4C. I'm just refreshing. I know we even did all the artbacks and got the total, but there's no harm in doing a review. So Kalebu Wekesa and Babu in partnership trading as Kaweba. Trading as Kaweba traders and sharing profits and losses equally. The partners have presented the following statement of profit and loss for the year. So they have sales, opening stock, purchases, closing stock, gross profit, profit on sale of furniture, insurance compensation for stolen car, discounts received, farming income, dividend income is net, less expenses, mortgage interest, furniture at cost, depreciation, general expenses, salaries and wages, customs duty, conveyance fees, legal expenses, repair and maintenance, VAT paid, interest on capital, bank charges, rent and rates, auditing and accountancy fees. Motor vehicle expenses, insurance, giving us a net loss of 40,52,770. So that's a net loss. Then there is additional information. Mortgage interest related to partners' residential house. 2, insurance premium include 259,900 paid to insure Wekesa's private car. 3, the investment allowances were agreed with the Revenue Authority at 1,357,000 during the year ended. Now, the partners took goods for personal use, which were recorded as sales, which had a cost price of 207,000. The gross profit margin was 20%. Salaries and wages included Kalebu, Wekesa, Babu. Interest on capital comprised Kalebu, Wekesa, Babu. Legal fees include preparation of tender documents, parking fines paid to county government, court charges for breach of contract, appeal against tax assessment defending a partner in a local committee, embezzlement expenses, general expenses included embezzlement by a cashier, registration of trademark, office partition, director's Christmas party, repair and maintenance comprised of new tables, laptops, and computers, fixing broken chairs and tables. So what's the requirement? Adjusted partner, it should be a statement of adjusted partnership profit or loss for the year, and then the allocation of profit or loss computed. So he said the examiner will always ask you for those two things, and there's a reason. The first reason is the statement will be given has been prepared from accounting point of view, the reported profit from accounting principles. So you want to adjust from accounting to the profit required for tax purposes. That's one. Secondly, in our definition, we said a partnership is not a legal entity. So even after adjusting profit for the partnership, you cannot tax the partnership. So you distribute the profit to the partners, then tax each of the partners individually because they are natural persons. Partners are legal entities. They are natural persons in law. So We did part of this yesterday, so it's just a review. So 0 and 1. The partnership is called KASNEB Traders, or KASNEB. So we are preparing a statement of adjustment. I use 2023 because that will be your year of reference. That will be the year of reference for your exam. Your exam will be asking you to prepare statements for 2023. So actually we are doing a rehearsal. This would be a rehearsal. So we have the reported loss. The reported loss is 40, 52.77. So that's negative. Then you see add back. So he said, start your adjustments from the trading account. So trading account includes cost of goods sold. And yesterday we read a note which will touch on the cost of goods sold. The note was note number 4, note 4. It says, the partners took goods for personal use, drawings, which were recorded as sales. So they were recorded as sales. Let me just pick my calculator here. So I was reading note 4. The partners took goods for personal use, which were recorded as sales, which had a cost price of 207,000. The gross profit margin was 20%. So we said these goods affect two things. They affect the cost of goods and they also affect sales. So we have to get the value of goods at selling price, the value of goods at cost price has been given, 207. So what we are looking for is the selling price, because the goods also affect sales. Why? Because they were recognized as sales. So we need to adjust cost of goods and sales also. So we had opened a note yesterday. And we said drawings of goods. Those are drawings of goods by partners. So cost of goods or cost price of goods in thousands of shillings was 207. Then we said to the cost, you're supposed to add your markup if you are truly selling. So what is your percent profit on what is your percent profit on cost? We did not have that. So once you have your markup, you add to that is what you're going to give you the selling price. So we did not have the selling price. We did not have the markup, but we said you can get both from the information the examiner had given. The examiner had given margin. So you have to know how to work with markup, the concept of markup and margin. And we said generally, if markup is given, change it to a fraction, say 1 over n. That is markup. Then margin will be 1 over n plus 1. In our question, what we had was margin. 20% is 20 over 100. 20 over 100 as a fraction is 1/5. 1 over 5, 20 over 100. So if I come backwards to markup, it will be 1 over 5 minus 1. So markup is a quarter. A quarter is 25%. So our markup here will be 25% or a quarter of the cost price. And we did that math yesterday. So 25% of the cost price of 207 gives us this 51.75. So that gives us selling price to be 258.75. So what will be the adjustment? There'll be two adjustments. The cost was included in cost of goods sold. So cost of goods sold was overstated. Okay? If cost of goods sold was overstated because it included cost of goods which were not sold, they were taken for personal use by the partners, then it means profit was understated. To correct that, add back employees of goods cost. The cost of sale was overstated, so you correct that by adding to the reported profit 207. The other selling price will have to wait until we come to deductions. Then we can deduct the selling price from the sales because the goods were not sold. They were taken by the partners. So that's the adjustment we did yesterday for the trading account. We'll wait for the selling price for its turn when we come to deductions. So those were the first, that was the first adjustment we did, which is in the trading account, in the cost of sale. Then I said from the trading account, you go to expenses. And the first item there was called mortgage interest, 552. Then you remember there's additional information, number 1. It says mortgage interest relates to a partner's residential house. What does that tell you? Mortgage interest is not for business. It's related to the partner buying his own house, so it is personal. So we'll add back mortgage interest because it's not part of business costs. So mortgage interest. It's related to a partner's residential house. I'll say here partners. So that relates to a partner, and we add back 552. Like that. 552. I will list them just like yesterday, then you will remind me of the total. You know, we'll put the same total we had yesterday. Well, we can confirm whether we've correctly, put items the way we had put it yesterday before we put the total. The next item is furniture, which was part of the capital expenditure we had discussed. We said one of the adjustments we'll be doing in the accounting profit is look for capital expenditures and add them back. So we'll add back this furniture cost. It is capital in nature, 138. So furniture. Excuse me. Furniture cost is 138. So we added back that. Furniture cost. Depreciation is 529. Depreciation is a loss of a capital nature, meaning it is the loss relating to assets. So it's also not allowed. We gave it as an example in our discussion yesterday, 529. That's depreciation. General expenses, there is a note in additional information. This could be note. 8, probably. General expenses included embezzlement by a cashier. I explained that that is theft. Embezzlement is theft. So theft is not part of the cost of generating income. So I'll add back embezzlement. It's not a business expense. It doesn't generate any income. Embezzlement by cashier. So embezzlement by cashier, you can add back 678. So we are adjusting the profit for accounting purposes so that we can get the profit for tax purposes. So embezzlement, registration of a trademark. A trademark is an asset, we said. So this is capital expenditure. So add back registration of a trademark, 337.5. So registration of trademark. Registration of trademark is 337.5. Office partition, again, capital expense. We add back 510. So office partitions. Add back 510. Director's Christmas party is a private affair. It's not for all employees. If it was for employees, we would have argued, this is for the welfare of staff. So the welfare of staff means you're motivating staff is likely to result into increased productivity by the workers, but now it's only for the directors, so it's disallowed. So this one is only for directors, so we'll add it back. This was under general expenses. I'll say director's Christmas party is 575. So we are done with general expenses. Back to our statement. So our statement is our guide. After general expenses, we have salaries and wages. Again, there's a note on salaries and wages. Look at note number 5. So it includes salaries and wages include salaries paid to partners. We said any payment to partners is specifically not allowed. We say here partner salaries. So who are the partners here? Kalebu, 1035, Wekesa. Wekesa is 1380. Babu is 1150. So that's salaries and wages. Back to our statement. The next item there is customs duty. Customs duty is a tax. All taxes are not allowed. So add back customs duty. Now customs duty here is 209.3. Customs duty is 209.3. Then conveyance fees. We did mention yesterday that conveyance refers to legal expenses relating to purchase of property. Property can be buildings, can be land. Any legal cost relating to purchase of property is referred to as conveyance fees. The area of law dealing with conveyancing is strictly about legal matters relating to purchase of land and buildings. So this is capital cost. So conveyance fees, anytime you see conveyance, know that it's capital expenditure. Conveyance fees is 195.5. So conveyance fees. $195.5. Legal expenses as a note. So legal expenses, we go back to our additional information. Legal expenses, yes. They are calling it legal fees to include preparation of tender documents. So what's a tender? A tender are contracts issued out to suppliers to bring supplies of stock, of goods. So that is business. So the business cannot run without supplies of goods, of stock, and so on. So preparation of tender documents is in relation to purchase of stock. For the current period, it's allowed. Tender documents. Parking fines paid to county government is not allowed. Why? It's a penalty. There must have been a parking offense. They parked in the wrong place, or they parked for too long, or they did not pay their parking as required by, so they're being fined. Add back parking fines. Parking fines. Paid to county. Parking fines paid to county. Court charges for breach. Breach means they broke an agreement, so they are guilty. So penalties for breaches are not allowed. So you break the law and you're charged, that's not a business cost. So court charges for breach, or you just call it breach of contract. Court charges for breach is 368. We add that back. Appeal against tax assessment is also not allowed. Tax appeal is not a business cost. So tax appeal against assessment. Against assessment is 75. Defense of a partner in the local committee. Yesterday I explained what a local committee is. So a local committee is established by the CS of the National Treasury. It has a chairman or a chairperson and members. Their main role is to, shall I say, discuss tax matters in order to provide solutions, in order for the matter not to be escalated maybe to the court, you know. So a taxpayer and KRA are listened to by this team. So the only expert is the secretary, who will be, as you know, a person versed with tax matters from KRA. The rest are respected business people in an area. So you could have a local committee in accounting. So they help solve tax issues before, you know, so that the matters don't go far. Ni kama a way of dispute resolution, you know, through negotiation. But this is not really negotiation. They have a session like a court, and they listen to both parties and they respond within 14 days. So defense of a partner in a local committee is not allowed. So defense of partner and the local committee. So this is 216. So we are done with legal expenses. Again, back to our statement. About that, there's repairs and maintenance. Again, there's a note. So you must be very careful to follow every expense and the relating note in the exam. You must be very careful. So once you read through the question, then you'll have an idea which expenses have a note. So you'll always be referring to the note. So the last note there is repairs and maintenance. It comprises of new office tables is capital expense. So new office tables. New office tables is 280. That's capital expenditure. Laptops and computers is 450. Fixing broken chairs and tables, now that's repairs. They're fixing broken chairs and tables, that's repairs. Back to our statement. After repair and maintenance, there's VAT paid, 94.3. VAT is a tax. All taxes are not allowed. VAT paid. And the amount of VAT paid is 94.3. Interest on capital with a note. There's a note on interest on capital. Now we go to that note. Note 6, interest on capital comprise. These ones of partners are not allowable on capital. It comprises interest to KASNEB. So KASNEB receives 374. 374.9. Rekesa. So Rekesa is paid 170.2. Babu is 414. That's interest on capital. Back to our statement. Bank charges are allowable. Those are legitimate business costs. So bank charges are allowed, so we not add them back. Rent and rates, we did not have any additional information on rents and rates, so it's allowable. Auditing and accountancy fees is allowable. Motor vehicle expenses is allowable. Insurance premium, there is a note on insurance, and that's note number 2. So we'll go to note 2. It says, insurance premium include 259.9 paid to insure Wekesa's private car. So again, that's personal. So insurance Wekesa's car. So again, that's private, 259.9. So with that, we are done with add backs. So I'll not add this right away, we'll add it. But let's first do deductions. So we'll put the additions here. Actually, we had already added yesterday. We'll just be confirming. So deduct. So under deductions, we remember our working note. This selling price of goods taken was included in sales. Those goods were not sold. So say goods or drawings of goods at selling price. At selling price. The selling price of the goods you remove from sales, 258.75. So those goods were not sold. You remove them. What else? Go to our statement. Now you go to the income side, not expenses, the incomes, especially after gross profit. So after gross profit, they have other sources like profit on sale of furniture, which is a capital gain, not taxable. That's an untaxable income. So profit on sale of furniture. It's not taxable. Non-taxable income, we deduct 1359.3. Next item, insurance compensation for stolen car. So a car is a capital item, an asset. So compensation for a car, we will deduct. It's not taxable. Had it been compensation for stock, that would be trading income. So insurance compensation, we deduct. So insurance compensation. This is for a car, so that makes it a capital item, non-taxable income for a saloon car, 713. So 713 will be deducted. What is the next thing? Discounts received is a trading income, is a trading gain, is part of gains from trading. So discounts we leave. Farming income is other sources, other activities. We said other specified sources must be deducted. So farming income of 192.05 is deducted. The farming income is a different activity. It's 192.05. Farming income, we deduct that. Next, dividend income, the same. Dividend is investment. It's the source is called investment. So those are other sources. So deduct dividend income 517.5, dividend income. $517.5. So those are our deductions, except one thing. We've not claimed investment allowances. We said all the assets we have added back, we need to claim investment allowances. But for our case, the amount was already agreed with the Revenue Authority. You find it in note 3. In note 3, they say investment allowances were agreed with the Revenue Authority at $1,357,000 during the year. So I'll come here and say investment allowances already agreed. Is 1357. With that, we are done. We can be able to get the answer to the first requirement. The adjusted. So we have the statement, but we need to have the figure now. So this is the statement, but we need to have the figure by putting these numbers. So our deductions, we have 258.75 plus 1359.3 plus 713 plus 192.05 plus 517.5 plus 1357. So we can confirm this. But I think I'm getting the wrong figure. The right figure is 4397.6, and these are deductions. 4397.6. You can also confirm these figures and see whether they are true. Then add balance. This add-backs in 10 to 16.8. Now we can get our adjusted profit or loss. Oh, Olivia has confirmed that deductions are 4397.6. Okay, good. So here's our adjusted profit. It's 1866.43. 1866.43, you call that adjusted partnership profit. So adjusted partnership profit, or ikiwa loss, but this is a profit, 1866.43. So that is the conclusion of our first statement. So in the first instance, the examiner wanted the statement of adjusted partnership profit or loss. We've done that. So in this next statement, they want you to distribute that to the partners. So we prepare another statement, which we call a distribution schedule. So using 1866.43, so let's prepare a distribution schedule. So we distribute that income, trading income, to the partners. So let's do that. So Roman 2. So we have a distribution schedule. So we have KASNEB. They share profits and losses equally. So the profit and loss sharing ratio is 1/3. That's the profit and loss sharing ratio in thousands of shillings. Wekesa. Hii 1/3. Profit share. So we have Wekesa. Who else? Bubbles. There are 3 partners in this. And the total. So you do direct allocations for items that were already given in additional information. So you just give direct allocations. For example, note number 5 as partner's salary. Or I can start with interest on capital. So interest on capital is on note 6. KASNEB, interest on capital is 374.9. . 170.2, 414. Then I'll add together the total. Then we also have partner salaries. And label is 10.5, 1380 for KSR, 1150. Then simply add the totals of what they had been allocated. So 374.29 plus 170.2 plus 414 is 959.1. Then salaries we have 1035 plus 1380 plus 1150, 3565. The only other matter that comes in this schedule is interest on cash drawings. This question did not have interest on cash drawings, so I'll just bring in share of it. Or in some cases of loss, so I do that by getting just this. Then the same adjusted profit I had earlier is what we bring here. In the first statement, we have 1866.43. So what do I do? I take 1866.43, subtract interest on capital minus 959.1 minus 3565. The difference, whatever is left, is negative. Yeah, it's negative. It's actually a loss. 56.67 negative. So everybody gets an equal share of that. This is 885.89 negative. Then I get the subtotals for each. Like 374.9 at 1035 minus 885.89. We'll get 524.01. Then 170.2 plus 1380 minus 885.89 gets 64.31. 414 plus 1150 minus 85.89. Now to confirm, I'll add this, see whether I get 1866.43. And I get exactly that, 1866.3. So my allocation of the trading profit is okay. So I've only allocated one source, but there were other sources of income. So we want to share the other sources of income. So go back again to the statement of accounting profit. Look at the incomes after the gross profit. Profit on sale of shares is not taxable. That's non-taxable income. Insurance compensation for stolen car, that's non-taxable income. Discounts is included in trading. What we want to bring in is farming. And for farming, the examiner did not give us the expenses, so we just share what there is. So farming income. How much was farming income? 192.05. 192.05 divided by 3. Profit sharing ratio. So you get 64.017. 64.017. 64.01. So then there is dividend income net. For dividend income, there's a withholding tax of 5%, which is final tax. Final tax means you don't tax it again. So this is all there is. So you get the total of this and call it total taxable income of each party. So that is what we are going to tax them on. So we just add this. 588. So that's the total taxable income. And that finalizes that question. Anyone with a question? So that is how you deal with a partnership question. The examiner will be asking for only 2 statements. First of all, the statement adjusted. For tax purposes, yesterday we discussed why they are different. So it is those differences that you use to prepare the adjustment. Then you distribute. Why? Because a partnership is not a legal entity. So even if you adjust the profit for the business cannot be taxed because the business does not exist in law. It is not a business entity that is distinct and separate. So that's the logic for preparing the distribution. Very well. So we look at another illustration. Let's pick another illustration for partnership. I think the other illustration is in May 2021. May 2021, really. May 2021 did not have a partnership, which is rare. So see you May 2021. Actually, May 2021, it's very rare kukosa kupata partnership. Question 5C. Naitwa Wangu Enterprises. So we have May 2021. Question 5C. It's called Mawa Enterprises. So if you can turn to Mawa Enterprises. So May 2021, question 5C is called Mawa Enterprises. They call themselves Mawa Enterprises. So I'll read the question. It says, Mark and Wangu are in trading partnership, operating as Mawa Enterprises and sharing profits or losses in the ratio of 2:3, respectively. The following statement of profit or loss was prepared by the business for the year ended 31st December. So they prepared a statement, Mawa Enterprises, statement of profit or loss for the year. So gross sales, unrealized foreign exchange gain, insurance recovery on stolen goods, over provision for bad debts, dividends from Haki Cooperative Society, interest on drawings, giving us total income of 3,173,500. General expenses, less expenses, general expenses, legal expenses, salaries to partners, drawings by partners, commission to partners, interest on partners' capital, purchase of furniture, donations to poverty commission, construction of fire exit, giving us net profit of 994,500. Additional information, gross sales include VAT at the rate of 14%. We're going to use 16%, the current rate. In addition, 10% of sales before VAT represents closing stock. The stock had been overstated by 20%. The amounts due to partners are to be apportioned according to the profit or loss sharing ratio. General expenses comprise partition of business premises, debt collection expenses, purchase of office stationery, cash embezzled by partner's wife, bad debts written off, business premises rent, salaries to employees. Legal expenses include acquisition of patent rights, drafting of sales agreement, negotiating sales contract, defending the business against a trade dispute, mortgage interest for Mark, defending partners against wrong tax assessment, conveyance fees for business premises, tax consultancy fees. The purchases represent 40% of the gross sales figure of 2736,000. The purchases have been understated by 25% and were omitted from the income statement. Required adjusted partnership, so it should be statement of adjusted partnership profit or loss for the year. Statement of adjusted partnership profit or loss for the year, then allocation of profit or loss computed. So again, as is usually the case, we will pick it from the reported profit or loss, and then begin adjustments from there. So the reported profit is 994.5. So reported add back. So again, start from the trading account. Which information relates to the trading account? You have note number 1 and note number 5. So let's look at note number 1. It says gross sales include VAT. So we'll make sure we deduct VAT from the gross sales because VAT is a tax and tax is not allowed. So why? Because tax is not an expense. It's not a cost that you require to generate profit. It's an appropriation. It means you only pay tax after you've already generated profit. So I don't need, tax is not like rent. I have to pay rent to produce income. I have to pay salaries to produce income. I have to pay electricity to produce income. But I don't have to pay tax to produce income. I pay tax after I've generated profit. So the VAT in sales will be deducted from sales later. In addition, 10% of sales before VAT represents closing stock. The stock had been overstated. So we need a bit of working with that. Like that. First of all, VAT included in sales. But that would be a deduction according to note 1. So you have sales plus VAT, then you'll have the sales inclusive of VAT. Sales is 100%. Add 16%. So what you have as sales right now is equal to 116%. 100% plus another 16 VAT. So let's have an understanding of that first. So our gross sales of 27,36,000 is 116%. It includes VAT in there. But then this is what we are told. 10% of sales before VAT represents closing stock. So 10% of 27,36 is closing stock. But then that closing stock has been overstated by 20%. Now, before we make any adjustment, you have to think. And here's the thinking, okay? If I overstate closing stock, what is the effect on profit? Now, for you to get a clear thinking, you have to think in terms of cost of goods sold. How do you prepare cost of goods sold? Opening stock. I don't mind putting it here. So the flow is opening stock, add purchases, less closing stock. What does that give you? Cost of sales. Now you can see clearly because it's visual. If I overstate this item, if this item is too big, then my cost will be understated. If you overstate the cost of goods sold, like in our case, then my cost of goods sold will be understated. If my cost of goods sold is understated, then profit is overstated. So our current profit is overstated because we overstated closing stock by 20%. Because we had overstated closing stock by 20%, we understated the cost of goods sold. So we overstated the profit. So the correction of that note of overstating closing stock is to deduct it. Deduct it from profit because it overstated profit. So we are going to come to deductions later. I just wanted to put this so that you can understand. You know, when you see visually, you understand more. So item 1, note 1, will not be adjusted for until we come to deductions. We'll deduct item 1 directly from, we'll deduct note 1 directly from profit. So we leave note 1. So it will not come until we come to profits. Until we come to deductions. Then I go to item 5. I was looking for items that affect the trading account. Right? The next item is note 5. There's nothing else so far. Note 5. It says purchases represent 40% of this gross sales figure. The gross sales figure includes VAT of 2736. So 40% of that is purchases. The purchases have been understated by 25%. So they are more than that. So that figure is an understatement of purchases. If I get 40% of 2736, I'm not in a rush to get that. But if I get that figure, 40% times 2736, it will be purchases, but it will still be an understatement of purchases. It will only be 75% of the true purchases. So I can use that idea to get the correct amount of purchases, to get 100% of purchases. Then here is the bombshell. Those purchases were omitted from the income statement. Totally, they were omitted. So you ask yourself, if I don't put purchases in the income statement, what is the implication of that? Cost of goods sold will be understated. Understated. Because I've totally omitted purchases. So if cost of goods is understated, profit is overstated. So even note 5 is a deduction. I omitted cost of goods sold, so my profit is overstated. When you come to deductions, so when you come to deductions, I'll have to deduct 3 things. Just to remind us, right? I'll deduct VAT included in sales because it's not supposed to be there. This will be my first deduction. What else will I deduct? I'll deduct overstated closing stock because it overstated profit. So I'll also deduct overstated closing stock. Overstated. This one will also be deducted. What else will I deduct? Purchases, which was totally omitted. So all those items of the trading account will wait until deductions. So tumemalizana na trading account for now, just for now. Let's go down to expenses. The first expense item is called general expenses, and you check additional information, it is there. Note 3, general expenses is in note 3. It is there. So let's look at the breakdown. The first thing, partition of the business premises. Partitions are capital expenditures, so we add back partitions of premises. So partitions of premises. So we add back 64. Debt collection expenses is allowed. That is part of trading. They must have instructed their lawyers to write to the debtors to put pressure so that debts can be paid. Debt collection expenses is allowable. Purchase of office stationery is normal business costs, is allowable. Cash embezzlement again by the wife, 48. So cash embezzlement. By partner's wife. Cash embezzled by partner's wife, 48. Adverb. Bad debts written off is allowable. Bad debts written off. Business premises rent is allowable. You have to pay rent for the premises. Salaries to employees is allowed. So in general expenses, only these two are not allowed. Partition of premises because it's capital expenditure and cash embezzled by partner's wife. Back to our statement, the next is legal expenses, and there's a note again. Legal expenses as note 4. So we go through note 4. Acquisition of patent rights. A patent is an asset. So on the legal cost, we bring in acquisition of patent rights. Acquisition of patent rights is 24.8. Drafting of sales agreement. Drafting of sales agreement is 34. Negotiating sales contracts is a preliminary cost. Not allowable. The process of negotiating is preliminary. Defending the business against a trade dispute is allowed. Trade dispute. The partners may a customer may disagree with the balances. Then you have a dispute, or there's a dispute in relation to the property belonging to the business. So trade disputes are common, and that's part of business. So defending the business against a trade dispute is allowable, but there's mortgage interest for Mark, a partner, so that's personal. 140, mortgage interest. Defending partners against wrong tax assessment. They went to appeal against assessment. We said tax appeals are not allowable. So defense of partners. Tax assessment. Conveyance, we said, is legal fees relating to buying of property. So conveyance fees, 125.8. Tax consultancy fees is 72.5. So that's a legal expenses. The next in the statement is salaries to partners, which is not allowable, 450. Salaries to partners, drawings by partners. Commission to partners. Interest on partners' capital is 250. Purchase of furniture is capital expenditure. Donation to Poverty Commission will allow. Normally, donations to charitable organizations are allowable. We would say this commission dealing in poverty is a national commission, probably to deal with poverty issues, so we'll allow that. Construction of fire exit is also allowable. Why? Because the law requires that a building must have a fire exit, so construction of a fire exit would be allowed because it's a requirement of the law, just as requirements of NEMA for you to operate. So these are our adverts. Like that, then we'll say deduct. We go to the income side. First, we'll start with the workings we have here. We go to note 1. Sales include VAT. So we'll say VAT included in sales. It's going to be 16 out of 116. This one now, 16 out of the total, 116. We multiply by sales, 27, 36. So we get the VAT element. I've used 16 because 16 is the current rate and is the rate on which you'll be examined. So we'll stick to that. So the VAT in this case will be 377.379. So we deduct that. Still on note one, they say 10% of the gross sales before VAT is closing stock. So closing stock is 10% of 2736, which is 273.6. That's closing stock. Now, this closing stock was overstated. So because it was overstated, it understated the cost of goods sold and overstated the profit. So we deduct overstated closing stock. So it's overstated by 20%, so it's 100 plus 20, 120. So it's 20. So it's 20 over 120 times 10% times 2736. So closing stock is 10% of the gross sales before VAT. So 10% of the gross sales is closing stock. It's overstated by 20%. So it's equivalent to 100 plus 20, 120. So 120 over 120. So let's get the overstated closing stock. So overstated is 20 divided by 120 times 0.1 times 27, 36. Now that gives us 55.6 to deduct. So it overstated profit by 45,600, which we've deducted. Now we are done with note 1. We go to note 5. So purchases was totally omitted. So it overstated the profit because purchases is part of the goods sold there. So we will deduct purchases which are being omitted. So, and it's also overstated. So overstated purchases. Now I will just deduct the whole of purchases because it was omitted. So let's work and get purchases. So purchases is 40% of the gross sales, but these purchases have been understated by 25%. So you can correct that. Right? So purchases was how much? It was understated by 25%. So we will get 100%. We'll get 100%. What we'll have will be 75%. We'll divide by 75 multiplied by 100. So purchases was 40% of 27.36. But this amount called purchases had been understated by 75%. This is only 75%. So you divide this by 75, we multiply by 100. You get 100%. So let me explain what is here. Purchases is given as 40% of 27.36. But 40% of 27.36 is understatement. It's not the full amount. This is only 75%. So if this is 75%, what is 100%? You divide everything here by 75, then you multiply by 100. So the correct purchases should be 0.4 times 27.36. So purchases is 1094.4, but that is only 75%. So divide that by 75, multiply by 100 to get the full amount of purchases, which is 1459.2. It was left out, so it overstated. It overstated our profit. So we have now put it back. We've deducted purchases because it was supposed to be part of cost of goods sold. So we are done with note 5. Now we go to incomes in the income statement. Other incomes, right? Unrealized foreign exchange gain, it's not yet realized. So deduct unrealized. Unrealized. Unrealized foreign exchange gain is 16. Deduct that. Insurance recovery on stolen goods is business income. It's for goods, it's for stock. So we cannot deduct that. That's part of trading. Over provision for bad debts, we will deduct. Why? Because it's a general provision. It has to be specific. This is just a provision. So over provision. Over provision for bad debts. Over provision for bad debts is 34. That's a general provision, it's not an income. Dividends from Haki Cooperative Society, other specified sources deduct. So dividends from Haki. Interest on drawings deduct is non-taxable income. Then the examiner did not give us investment allowances, so you have to calculate investment allowances on all assets. So the rates of allowances will be given on your page 1 of your exam or your past paper. So you want to deduct investment allowances on all assets. Investment allowance. So where are the assets? We will get them. Up here we have partitions of premises. So partitions, you get 10% of 64 is 6.4. That's partitions, right? Mortgage interest, defense, conveyance, tax consultancy, drawings, purchase of furniture. Furniture. 10% of 96. 9.6. That's furniture. Do we have any other assets? Let me check again. Put furniture. We put partitions in note 1, note 3, the general expenses. Actually, there is no other assets because allowances are only claimed on tangible assets, not intangible. Tangible peke yake. So purchase of furniture and partitions in note 3 and the general expenses. These the two. So we are done. So this will give us adjusted partnership profit or loss. So let's get this. This is 944. Yes, I see the rates. 2479 easily deductions. Yeah. These are deductions. What is We add 1739 to 994.5, then we subtract 1944.479, and this is what we have, 789.921. That is what we call adjusted partnership profit. So that again is our first part. Any question? So that's the adjusted partnership profit of 789.921. You can also confirm the figures. Then as usual, we have to allocate this to the partner. So we distribute this. So we go to the
Malim,
yes.
Malim, I'm getting a different answer on the deductible. I don't know why.
No, it's okay, I can be wrong. So what are you getting? We can compare with the rest of the class. You're getting an answer like?
For the deductible, I'm getting 2035.679.
2035.679. Anybody getting a similar answer?
Malim, I'm getting the same.
2035.
Yes.
0.679. It's possible. It's possible that I omitted something. So if more than one person confirms it, we put here 2035.679. So it means we'll adjust this. The adjusted will be 698.721. So then we can distribute that to the partners. So we prepare a distribution schedule. So there are two partners here. Now the profit and loss sharing ratio is 2:3. This is 2/5. The other partner is called one. And the total. So we do our allocation. So let's do our allocation. So we'll start with salaries. So salaries, the total is 450. We've not been told yet how we are going to share that, but let's just put them. Salaries, the total is that. There is commission to partners, a total of 180. Then there is interest on capital. Interest on capital is a total of. Then on the income side, there's interest on drawings of 45. On drawings is on the income side. That's negative. Interest on drawings is a cost. Look at note 2. I think note 2 tells us what to do. Note number 2 says, the amounts due to partners are to be apportioned according to the profit or loss sharing ratio. So note 2 clarifies that. So anything due to partners, you use the profit or loss sharing ratio. For example, salary is 450. So this one will be 270. And this will be 180. So 150 is 90, so 2/5 is 180, 3/5 is 270. 180. 1/5 of 180 is that 45. This is 155. So 80 divided by 5 is 36. This omission. Eight. 72. The interest on capital is 250. 50, so this is 1. Like that. Then you bring in share of profit. So you have here 698 from 7 So what do? I take 698.721. I subtract minus 450. So 450 was salaries, minus 180. 180 is commission, minus 250. 250 is interest on capital, plus 45, because they are paying 45. And I get negative 126.279 negative. That I will share according to the profit and loss sharing ratio. This is 81 and 767. Then I get the subtotal for each partner. Then try to add these two, see whether you get 698.721 by adding the two. And you get that. So you've shared what was in the trading account. Then you can add any other sources. Other specified sources of income can be added at this point. So go to the question and get other sources of income. Actually, there's only one. So unrealized foreign exchange gain cannot be taxed until when the gains will be realized. So they cannot be taxed. Insurance recovery on stolen goods, it was already part of trading. Over provision for bad debts is not an income. So the only income there is dividends from Haki Cooperative, which is taxed twice. So bring here dividends. So this is Haki. So this dividend is taxed twice, and we are going to share the same way. 45, a fifth of 45 is 9, so this is 18. And the rest is total taxable. So we simply add now. So that's the taxable income. And the end of question. So now if you have any question you want to ask, you're free.
Dividends from Haki is 42,500.
Was?
42,500.
No, it's
42.
45. Ah, I'm looking at something different. It's
Yeah,
40.5. I use 45. It's okay. I'll change that. 42.5. 42.5. Okay. 42.5. Let me divide again. And we are assuming that that is the gross amount. Haki co-op, so let's assume that's the gross amount because you cannot tax it when it's net. So we'll take 42.5, we divide by 5 times 2. $42.5. Was it 0.5 or 0.25? 0.5. 42.5 divided by 5 times 3. 5. Then we add. So any questions? So in that case, I'll only give you one assignment. I'll give you one assignment question.
Mwalimu, I had a question
You can ask,
on the assets.
yes, assets.
When
Okay.
we were looking at assets,
Hmm.
why didn't we choose also the purchase of office stationery and it's an asset?
Office
Or is it
stationery is
not an
not a tangible asset. See, on the paper too, you cannot claim allowances on a, it has to be a physical asset. Like,
Okay.
a car, computers, computer software, partitions, not stationery. Stationery is just, stationery is what we call consumables. So you know stationery is consumed. Hakuna kitu inabaki after umetumia. But these are assets that remain, like tables, you know, like office furniture. They remain. So those are the ones you claim for. If you are the car for the business, a pickup, that's what we are talking about. So you're not talking about consumables. You cannot claim, huwezi claim an allowance for a consumable. So I'll give you an assignment. You can try. The assignment is from, it's question 5 of May 2018. May 2018, question 5C. It's called Chettel Traders. Chettel Traders is May 2018, question 5C. It's called Chettel. Chettel, yeah, like that, traders. So there are 3 partners. The 3 partners, there's a guy called Chege, another guy is called Telek. Yeah, they're just 2, Chettel. Or later they are joined by a guy called Lopez. So there's a guy called Chege, another guy called Telek, and later they are joined by another partner called Lopez. So that would be an assignment. I don't know how much time we have because I want to introduce something different. Oh, our time is up, but you can just put this embedding for the next class. I'll be discussing details of what we have in section, it's called section 15. So these are what we call allowable expenses. So this is section 15 of the Income Tax Act, section 15 of ITA, allowable expenses. So you've been seeing me take expenses and say, this one is not allowable, the other one is allowable, this one we add back. So I'll discuss the law that refers to that. So it's, and all the expenses listed there to guide us. So I'll be discussing section 15 of the ITA's Income Tax Act, what we call allowable expenses. Then after that, I'll also discuss section 16 of the ITA. This one is called disallowable expenses. So once we discuss those 2, you'll get a deeper understanding of why we choose to add back some things, why we deduct some things, and so on and so forth. so that after we are done with this, then we'll do our last business, which is limited companies, or if you like, limited liability companies. I'll go through this briefly and this. Then I'll look at our last business called limited liability companies. So limited liability companies are also called LLCs. Most likely we'll finish this next week. So after business, we go to investment allowances. Like, I'm sure you're wondering, you've seen me for furniture, I take 10% of the cost of furniture, probably for motor vehicles. Yesterday, I took 25%. That comes under the topic investment allowances. After limited companies, after we are through with business, this is the last business, after partnership, then you look at investment allowances. All right, so I think that's it for today. Unless somebody has a question they want to ask. So you can try May 2018 as an assignment. Then we'll see you on Saturday when we discuss briefly allowable expenses as under Section 15 of the Income Tax Act and disallowable expenses. Then the topic after that will be limited liability companies. Hopefully we can also go through May 2018 and so on and so forth. So thank you very much. See you next weekend. Have a very good evening. Asanteni sana. So enjoy the rest of the day.